I did explain in the previous recording uh, the case data. Now we are going to review the company's alternatives. Um, as you see in this slide, company has the choice of doing nothing, meaning the company might remain unhedged. This means that they would accept whatever the spot market deals to them at the time they receive £1 million. If the spot rate at that time is about 1.7, obviously they will be able to accomplish their objectives. But if the spot rate is anywhere below 1.7, they would fail to meet required minimum margin. So remaining unhedged could be quite risky, particularly over a 3-month period. So a lot of things can change in 3 months. Particularly currency markets are quite volatile. Political and economic developments could swing the exchange rates substantially. So that option is or should be considered a quite risky option, despite their forecasted $1.6 to pound rate. It is almost impossible to forecast exchange rate with some precision. So you should always be cautious about those forecasts. The other option that the company has is to hedge the receivable in the forward market. Simply, they could sell £1 million forward at the rate of 1.7540, which would give them $1,740,000. $1,754,000. I'm sorry, $1,754,000. That is roughly about 54,000 above the targeted dollar amount. The only downside of the forward market is that if for some reason the spot rate turns out to be about 1.7540, they wouldn't be able to take advantage of it. They are going to be protected on the downside, but they would not be able to participate in the upside when they enter into a forward contract. The other option that we have not discussed so far is to use a money market hedge. Money market hedge is very much similar to the forward contracts, but we instead of directly engaging in a forward contract, we emulate a forward contract. For instance, in this example, the company has £1 million receivable. Knowing this receivable in 3 months, company today can borrow present value of this 1 million receivable, which creates a liability of £1 million 3 months from now. When company receives £1 million, might cover this receivable. This liability. So receivable will cover the liability, and the company will not have a pound liability. Borrowing the present value of the £1 million will give them a certain amount of pounds today. These pounds can be converted into US dollars and then invested 3 months. And at the end of the 3-month, company will have a specific amount of US dollars. Simply, they would convert 1 million pound receivable into a certain amount of US dollars with certainty. And this is very much like receiving a certain amount of US dollars in exchange for 1 million pounds. So in a string of money market transactions, meaning first borrowing pounds in the money market and then converting it into US dollars in the spot market, in the currency markets, and then using again money markets to roll over the dollars that are produced in the process to create a certain amount of US dollars in exchange for 1 million pounds. So this process, which requires about 3 steps, borrow the future receivable today, convert into US dollars that you're going to you would like to have, and then invest these US dollars 3 months to carry it to June. So as of June, you're going to have that certain amount of US dollars. So it is a way of creating a certain amount of US dollars with certainty. That's why we call it a money market hedge. We will go through the mechanics of it in a little bit. The last option the company has is, or the last alternative the company has, is to use options market. The company has 2 possible put options that it can use. One of them is a little bit more expensive because it is at the money. The other one is a little bit cheaper because it is out of money. The at the money option costs about £15,000. Out of the money option costs about £10,000. So the company will decide which option would give them a better protection, or which one would be desirable, and we're going to consider on behalf of the company these 2 options and make a choice. So these are the alternatives that we have, and we are going to review each of them in turn and make a choice whether which one of these would be more desirable, or which one would be most rewarding and will help us to accomplish our objectives. Let's go to first the case where we remain unhedged. So in this alternative, as we mentioned, we are not going to do anything, and the spot rate that will prevail in June will determine how much dollar we receive. As I mentioned, this is a risky choice because if the spot rate is about 170, it's fine. But if the spot rate drops below 1.7, we have the risk of not earning the minimum margin that we strive to generate in this deal. So our position is going to be something like this. If we show it in graphical terms, this of course does not entertain all possible values of dollar pound, but we use a range from 1.69 to 1.78. So we might end up by as low as $1,690,000 or as large as $1,780,000 in this case. Obviously, we could go further down. The exchange rate could be as low as maybe 150, 155. Under those circumstances, we would be generating almost $1.5 million versus, say, in the upside of, in the case of 179, $1,790,000. As this graph suggests, there is quite a bit range in here. This means that there is a large, let's say, range of possible outcomes, and some of them could be detrimental. Particularly, any rate below 1.70 could be quite damaging for the firm. The next alternative is to use forward market hedge. As we said, we could lock into the rate of 1.7540, which will give us $1,754,000. This is about $54,000 above the required margin, or required, let's say, minimum amount. But it is about $6,000 less than the amount to be received if the forecasted spot rate realized. If you remember, the forecasted future spot rate is 1.76. Obviously, this is just a sort of a illusionary comparison. I mean, it's a paper comparison. We don't know what the spot rate is going to be at June. So Regardless what happens though, we are going to receive $1,754,000. If the exchange rate turns out to be 1.78, we are still going to collect $1,754,000. If the exchange rate turns out to be 1.6, we are still going to collect $1,754,000 in exchange for our 1 million pound. So this puts us into a situation like this. So the red line in this graph describes where we're going to be, regardless what the spot rate is. Obviously, in comparison to doing nothing or remaining unhedged, this option does well for a range of outcomes. So, for instance, up until the spot rate hits 1.74, forward hedge is going to be superior. But beyond that point, obviously, doing nothing is going to offer a better outcome for the company. But as you see in here, there's quite a bit downside in here, as we considered earlier. The forward hedge could be a reasonable option to entertain. So we're going to put it aside for a moment. We will think of one of the viable options or viable alternatives that we can utilize in this particular case, and move on to evaluate other tools that we could use to hedge the position that we have. In this particular case, as you know, we have a receivable which represents an asset in the foreign currency. We could also describe this position as a long position in the foreign currency. As a result, we are selling the foreign currency forward to convert it into a certain amount of US dollars. If we needed to use the appropriate option would be a put option, because again, we have a receivable in the foreign currency terms, and we are trying to establish a minimum value by using the options. In this case, the put option would be the appropriate option to use, and obviously the floor would be the option strike price minus the premium that we pay for the option. So we are going to consider the next two options in a second. I will give a short pause at this point to move on to the next recording.